Hey everybody, and welcome back to H Invests. Today I wanted to talk about my macro views in 2023 and how this relates back to the US stock market. I hope you guys enjoy the presentation. So, the first thing, this obviously isn't financial advice. Read the disclaimer. Hope you guys enjoy. The Federal Reserve, it continues to be more hawkish than the market. This was what this picture on the first slide is illustrating, Jay the Hawk Powell. Now what you can see from this graph is this is the 10-year Treasury minus the Fed's fund rate. And what you can see here is that it's dipped negative. So what this means is you get a higher rate on the Fed's funds than you do on a 10-year Treasury. And almost got down to 100 basis points at the start of January. Since filming this video at the start of March, the Treasury yield has risen considerably and it's now around 4%, but the base rate is between 4.5 to 4.75%. So we're still more than 50 basis points below where the Fed's fund rate would be. And obviously what this means is the market is buying up these long-term treasuries. That's what is keeping the price high and therefore pushing the yield down where it would otherwise be. And this is indicating that the market is very happy buying treasury yields, and it doesn't think that the inflation is going to be persistent. Hence, the market is very dovish on inflation, because why would you buy a bond and lock yourself into that bond for 10 years, in this case, or more? The rate on the 20 years and 30 years are also pretty low compared to the ones and the twos. Why would you lock yourself in for a long period of time at a rate that's below the rate of inflation, right? As I said, the rate is up to 4%. Until recently, it was 3.5%. Meanwhile, the inflation rate on the dollar officially is still over 6%. So why would you lock yourself in at a minus 2% a year rate, a real minus 2% a year rate, right? It's because the people buying these bonds think that inflation is going to go down and back towards its 2% long run target that is set by the Federal Reserve. So that is why we've seen this, and this is why the Federal Reserve can be perceived as at least more hawkish than the people buying those bonds. Here we have the inflation rates. Obviously, one of the big questions to ask from a macro point of view is inflation going down? And you can see that from at least the CPI, the very standard measure of inflation, the rate of increase has come down. Inflation hasn't come down, prices are still going up, but the rate of price increases has slowed down. It peaked at 9% year on year, and it's now at 6%. What's a little bit worrying about this though is this is 6% off a very high base. This is 6.4% above the 7.9%, or whatever this figure was here. It was 7 point something percent in that year. So inflation is still increasing a lot, and that has a compounding effect on prices. But however, the data looks like at least the rate of increase is coming down somewhat. Trading Economics are forecasting 6.2% increase for the month of February. However, recently the PCE, or the core inflation, stripping out foods and energy, which tend to be more volatile costs, and this is the Fed's favorite measure for inflation, that came much, much higher than what the market was expecting. So the consensus was 4.3, down from 4.6 previously, and the actual was 4.7. So there was a big shock from the market, and because the Fed likes to use this gauge of inflation the most, obviously that's bearish for the market, because they think, okay, the Fed's going to be more hawkish and carry on raising rates again and again. So that is something to bear in mind. But at least the same with this one, compared to the rate of increase, we have seen some relief. It's not as consistent as CPI as a whole, but there is some relief there. And obviously what this has done is there's been a big shift in the expectation for when the Fed is going to top out its hiking. So when is it going to stop its hiking? If you look at the 30-day Fed funds futures, you can see there's been a huge increase in what the futures market perceives the base rate to top out as. So back in February, this was at the start of February, right, the base rate that they thought the Fed was going to top out at was between 475 and 500. As we're recording of this video, we're actually at 450 to 475 now. So they thought there'd only be one more rate hike, and then it's also been priced in that it's going to start coming down towards the end of the year and finish the year back at 4.5 to 4.75. However, if you look at the data as of yesterday, so this is the start of March, recording this video, you can see that now it's pricing in a 5.25 to 5.5% increase and no rate cuts in 2023 at all. Again, the mode for basically the rest of 2023, for the whole second half, is that it stays at 5.25 to 5.5. So that's the data that we're now seeing from the market. It's been a big shift, and I think the market is accepting as a whole that we're going to see higher yields for longer, and of course that is bearish for the stock market, particularly if the inflation does start to come down, because then all of a sudden there's a huge opportunity cost to holding stocks if you can get higher and higher rates in the bond market. Okay, so this is another thing to bear in mind, is that the S&P over 1 year, if you just look at it from March to March, and it really hasn't gone down that much, considering obviously number one, the big rally that it was coming off at back here, but also number two, think about how much has changed. In March 2022, this was when the Fed was really starting to get scared. Inflation was running away. I think it was up to about 8% by this point, but the base rate, the federal funds rate, was still practically down at zero. Isn't that crazy? And in the time that we've had base rates go from almost zero to nearly 5%, the core S&P is only down 8%. I really don't think that's much, considering that for the whole of 2021, it was priced insanely, and it was also coming off a big high. Back here when it was near, 4,300, 4,400, it was pretty high multiples compared to historically. And it's actually crazy to me how little a decline we've seen, considering how big the rate increases have been and what that has done for the bond market. It's absolutely changed the bond market. Okay, so here's another big question on investors' minds. Is the US winning the fight against inflation? And I tell you now, the truth is, I don't know. Nobody actually knows, but what we can do is look at the data and we can assign different probabilities to different outcomes, right? So in terms of data that the Fed is winning the fight against inflation, we've been through that already. The rate of increase in prices is coming down to an extent. Prices are still going up, but the rate of that increase is down. It's down from a high of 9% down to around about 6% as of March 2023. Also, the rate of increase in export and import prices is almost flat. And you can also see the export prices in the US, they've come down a little bit. However, they remain very much elevated from pre-pandemic levels. So it's not like they've come back down, it's still expensive, but there is some relief there in terms of what the US is producing domestically and then exporting to the rest of the world. There's a very similar pattern for import prices, by the way. However, there's also a lot of evidence that the Fed is not winning the fight against inflation, and I would probably fall into this camp. It's not that I have a strong conviction that they're not winning. I'm yet to see a lot of data to say that they are winning, and there's a lot of things to consider that could point to the fact that they're actually not winning the fight against inflation. So if we look at the money supply, which I can show you, I think it's on the next chart. If we look at the money supply, very little of that money supply increase during 2020 to 2022 has been recalled by the Fed. Everyone always goes on about interest rates, but remember, Feds have two tools. They can do whatever they can with the base rate and move that around, but they can also print money, increase the money supply. They can also do quantitative tightening and retract the money supply. And if you look at the money supply here, yes, in the past year, they have been buying back some of those bonds and taking them out of the market. But I think, look at this. The money supply was close to 4 trillion for the later half of the teen decade, right? And when we get to 2020, it basically doubled from 4 trillion to 8 trillion, peaked at 9 trillion, and now we're not even back at 8 trillion. That money's gone to the banks, it's gone to the governments to fund deficit spending. That money has to go somewhere. And if you look at at least what the CPI is recording for an inflation measure, it really doesn't seem like we haven't seen this money in the wider economy. You haven't seen an inflationary effect there. And the fact that the Federal Reserve, if they keep buying back at this rate, when are we ever going to get back down to 4 trillion? So this is something that points to the fact that maybe we haven't seen the full Monty when it comes to inflation yet. The labour market continues to be very strong. That's something that I'm sure everyone will be aware of, particularly in the blue-collar service sector jobs. That means that obviously workers have more leverage and then they can force higher wages. Most key commodities are also not back down to their pre-COVID levels, right? If you really want to break things back down to basics, right? everything comes from something physical, or virtually everything comes from something physical, right? Everything needs to get produced, and if those commodity costs are high, then obviously they're going to be passed down the supply chain towards the consumer. And if you look at most of those commodities, just on the chart basis in US dollars, and that is another key thing because the US dollar is much stronger since before pre-COVID. Oil remains elevated, gas remains elevated, aluminium remains elevated, iron ore is elevated, lumber has receded somewhat, but it's still above pre-COVID levels. Soy is elevated, corn's elevated, poultry is elevated, beef is elevated. Hogs, again, they've come down somewhat, but it's still very expensive compared to what you look at pre-COVID levels. It's not back down below that trend. So, you know, these commodities that I've highlighted, they make up large swaths of economies, you know, for imports and exports, and obviously making everything, food, cars, you know, energy to function. Oil is a big one, and oil is still very high. So that's something else to consider, is that if the core commodity prices haven't receded completely, and a lot of them remain still at very elevated levels, I really encourage people to go and have a look at the charts. That is not bullish for an inflation fight. We need to see those commodities come down, because there's only so long that businesses can be hedged against commodity prices. You know, there's only so long they can be hedged against that before that hedging expires, and they need to do new hedging at much higher prices. And also the Q4 results were not very good. We saw a lot of businesses rent-seeking, increasing prices just on the same product without really delivering additional value. And that's the only way they've been able to grow their revenue in Q4. I'll provide some more data on that later. So I don't know if the Fed is winning the inflation fight or not, but what I'm saying is there's a lot to suggest that there's a lot of work to do with inflation, and you know what we saw in the last crisis was very much unprecedented. You know, the amount of printing money that was done, it was a lot compared to the GFC. In the GFC, Obama approved, I think it was 800 or 900 billion in stimulus. Obviously, the Federal Reserve's balance sheet doubled. That was an extra 4 trillion. And I think on this slide here, yes, the government spending, it spiked hugely. Donald Trump did a 1.2, or maybe it was even 2 trillion. I think it might have been a $2 trillion stimulus package. And then Biden did another one just a year later. So this is the spending you can see on this graph. I'm sure in this quarter, there was a lot of other things that went into that, but a huge part of it was this whole CARES package, the whole stimulus to help Americans through the pandemic. So all of this money had to go somewhere. There was a lot of spending done in 2021. You can look at retail sales and that sort of thing, and now there's a lot of evidence to suggest that consumers are coming back. But if you look at how significant these increases were, have we really seen that in, you know, a 9% peaking CPI? If you compound that over a couple of years, we're talking 16, 17% inflation or price increase above pre-pandemic levels. You know, the money printing and the money spending has been much higher than that. So that is one thing to suggest maybe this fight is not over as quick as we thought. Yes, Jay the Hawk Powell, here he is again. What we're going to talk about now is we're going to talk about evidence for a strong or weak economy, because this is the other component. Like, everyone who's watching this presentation, they are interested to know what's happening with the stock market. And of course, what happens with inflation and interest rates determine the stock market, but also sentiment in the economy. All of these things are linked together. So we're going to talk about whether the economy is strong or weak. My view at the moment is that the market is more optimistic than it should be. The market has not been in the euphoric state that it was in for the whole of 2021, but it has been in a very optimistic state. And I think, looking at the data, a little bit too optimistic. But I'm going to try not to be biased, because there are some positives in the data. Unemployment being low, GDP, it is still positive. It was technically in a recession for 2 quarters last year, but it's back to being positive, and it beat expectations for Q4 of 2022. Some of the consumer data is still strong as well. So there's all of that, and I will show those charts in a minute. However, there's also a lot of data on the right-hand side, which is suggesting that the economy is not quite as strong as a lot of those bulls believe it to be. If we look at the unemployment first, yeah, you can see it's at a 50-year low. It's an absolute insane low. I think it's at about 3.4% at the moment. So great, everyone's in work, right? What's the problem? Everyone can find jobs. One thing to bear in mind is that blue collar and low wage jobs, as I mentioned earlier, that have many openings, especially in sectors such as leisure and hospitality and retail. What we're seeing, obviously, coming out of the pandemic, a lot of people are very much focused on spending their money on experiences, traveling, doing this, doing that to compensate for when they were locked away in their homes for a couple of years, and maybe they spent a high proportion of their money on goods and material items, decorating the house, that sort of thing. Now they've gone the other way. Now the economy has opened up again. In 2022, we saw services, leisure, experience. There was insanely high demand there. So there's a lot of job openings in those kind of sectors. Construction was pretty flat year on year, which is never a good sign for the economy. And the one that saw the big increase in unemployment in Jan 22 was actually since Jan 22 was actually the financial service sector, which I thought was very interesting. So, I mean, the only thing is I do take issue with this because the Fed is saying, oh, we can raise rates. We have this strong economy because the unemployment rate is so low and we can raise rates. But when you actually look at this, when you have low unemployment rates, you typically see a very sharp swing up. This is almost the opposite pattern of the stock market. The stock market usually goes up pretty slowly and consistently and then crashes quickly. Here, what we can see is unemployment, it goes down slowly and consistently, and then there's a spike. You could say just before .com or like this 2001, 2002 recession, everything is great. Unemployment is at a decade low. But just before the GFC, unemployment was at close to decade low. So yeah, this is the thing, like just before the 1970s, again, unemployment was very, very low. And if you actually look at it, when you put a recession, which are the grey bars, onto this graph, you can actually see that when you look at the trend, low unemployment is probably more of a signal of a recession than a signal for a strong economy. Honestly, it really is, because you have employment goes down slowly and then it spikes upward again. And this is the unemployment rate by month, zoomed into the GFC. I know you can't see it by month very well on the x-axis, but what you can do is you can, drag a little slider and it will show you the exact month. So these A and B figures are very accurate. And A is where the S&P topped out in June 2007, when the unemployment rate, again, it was getting back to that decade low trough, and it hadn't really been any lower than that since 2001, 2002. And obviously the prime of the GFC and the credit crunch, that was when the employment was spiking. And again, the S&P bottomed out in March 2009 when this employment was still on the rise. That can be seen by figure B. So for everyone watching this video that is looking at the economy and saying, what is this going to do for my investments in the stock market? Employment is a lagging indicator. It takes time for firms to feel the pinch, for them to do the cost restructuring and then doing layoffs. It takes a lot of time. We've obviously seen a lot of layoffs in the tech sector recently. I'm sure some of that is to do with a weakening economy. However, what you do have to compare that to is a lot of firms were hiring insanely in the pandemic, absolutely insanely. So what you need to do really is compare the pre-COVID figures to today's figures. And most of the big tech companies, it still looks like they employ more people today than they did at the start of the pandemic. However, the key point from this section is, employment is very, very low, and the Fed keeps saying, oh, well, we've got this strong economy because the unemployment is so low, and every time we get a low figure, they hike rates, when really, if you look at the trends, whenever employment sort of bottoms out at this low, we see a huge spike, and that's when we get the grey bars that are recessions. Here's another one. GDP for Q4 ahead of expectations. So US economy beats expectations with 2.9% growth. Obviously, we had this slight contraction in GDP growth earlier on in the year, but overall 2.9% growth, pretty good. Again, this is the overriding theme though, is that we're going to get this data, and a lot of the time the market acts bearishly to this because the market's just going to say, hang on a minute, this just means that the Fed is going to be more and more confident in its decision to hike rates. And I'll come back to this more in my conclusion, but this is pretty much where I'm at with the economy currently, is that we're in a bit of a rock and a hard place where the Fed is going to raise rates. We're coming off almost 20 years of being addicted to rates that are very close to zero, particularly in the last 15 years. We had some rate increases in 2018, 2019 that they then did the about face on. So we've been addicted to low rates, and all of a sudden we've got huge rates which are pushing a big strain on the economy because the economy is used to dealing with zero rates. All of a sudden capital has become much more expensive. However, every time we get strong figures, the Fed are going to keep going, and it's going to make it worse. Like it's going to crash the economy. The higher the rates are, the worse the economy is going to get. So this is the thing: is that like we either get that or we get inflation. You know, we get the Fed doing an about face, and we get inflation being sustained for a much longer period of time, as I demonstrated earlier. It's, you know, you'd have to have a lot of evidence and a lot of conviction to say the inflation fight is over. It most certainly is not over. So anyway, so we've got the US economy beating expectations, which is all good and fine, and that is a positive sign that obviously we're not in a recession. There are a lot of economists forecasting recession though, which could be a positive or negative sign depending on how accurate you think economists are. And a lot of the times they're not that accurate. However, this is another thing I wanted to say about GDP. It falls into a very similar bracket to unemployment. It's not a forward-looking measure. It takes time for the impacts of higher rates, changes in consumer spending, higher inflation, lowering of purchasing power, all of this to work its way into the final data, which is basically this huge basket which represents the US economy. So what you can see here is I've got the S&P 500 from June 2006 to June 2009, and on the left hand side we've got US GDP by quarter. So you can see at the end of 2007 it was still very strong. And by the way, again, I'm showing this because most people watching this presentation will be interested in how the economy is impacting their investments, what the macro is going to have an effect on. And you can see that when the stock market started to crash, you know, here, it's late 2007, it was becoming very, very evident that there was a housing crisis. Not an economic crisis, not even a financial crisis, but a housing crisis, a banking crisis. That's what was brewing here, basically. And what I'm trying to say is, you can see the huge, huge crash happened even when GDP was still positive. Yes, it was slowing down. We had a bad quarter in September 2008, but until sort of like September time, when the market started to crash, this data wasn't even being released yet. You know, the data for GDP only got really negative in late 2008, early 2009. And by the way, the stock market had bottomed out in March 2009. And by 2009, it had a really good rally. It was going up. You know, September 2009, GDP still minus 3%. And the stock market is, bam, it's gone up a huge percent from where it bottomed out. So again, GDP is a backward-looking measure. It doesn't forecast what's going to happen in the stock market. What we see with company earnings and sentiment and just the fact of how liquid it is, the stock market will react to a weakening economy much, much quicker than the GDP figures will. Here's another thing, consumer perception. So here we have consumer confidence and economic optimism. So I talked about this earlier. These figures are okay. They're not terrible, they're okay. I don't want to argue that they're in dire straits, but I mean, they're still pretty low. When you compare it to the last 10 years, it's pretty low. This red line is just where it is at its current level. So you can obviously see for all of the last 10 years in terms of US consumer confidence, this is just a survey of the US consumer, it's been much, much higher than where it's at today. Economic optimism, again, the numbers don't look great. They're okay, they're not dire straight, but they're not great. And maybe a factor of that is the fact that the stock market's still okay, only down 8% year on year from when we were at zero rates and everyone thinking that the Fed will get inflation under control to now we are close to 5% rates. But yeah, as I said, they're okay, they're not dire. But let's talk about some of the weak data and how that is now pointing towards recession. These ones on the right, I talked about how these aren't leading indicators. GDP and unemployment are often lagging indicators. The ones on the right are usually leading indicators. So this is the spread of yield per year between the 10-year and the 2-year. This is a very similar metric to looking at the Fed's fund rate and the 10-year, the same as what I did in the start of the presentation. The yield is negative. What does that mean? It means demand for long-term treasuries is high, pushing up the price and consequently pushing down the yield. And it signals a sign that investors are very bearish because they're buying up US treasuries, which is one of the safest assets. However, to me, it signals that they are actually incredibly, incredibly bearish because they're doing this with a negative real return, or at least as of yet, because the yield is still only 4%. and the inflation is all the way up at 6%. But anyway, so this yield curve is getting very, very deeply negative, where the 10 years just aren't catching up to the rates of the 2 years. The 2 years are going up with the base rates because the Fed controls the shorter part of the curve much more. And the 10 years are just not really following. They have done a bit recently, but like between September and February, I don't think they moved from 3.5 to 3.5%. I think they went up to 3.9 at one point and back down to 3.6, up to 3.7, down to 3.5. Now it's the first time they've really crossed over 4%. So that's a very bearish sign. Whenever the US investor and investors all over the world start buying up these treasuries, buying up the long-term treasuries, it's a sign that, people are bearish, particularly with the added risk of treasuries because of the inflation risk. So that's something to bear in mind. This is a very, very, very comprehensive leading indicator, one of my favorites and one of the most well-regarded in terms of the stock market. The Conference Board's Leading Economic Index, as you can see, it has a whole array of financial and non-financial components. We've got credit, we've got the spread, which I talked about earlier. This is the spread from the slide earlier. Consumer expectations, building permits, how's manufacturing doing? There is an unemployment component to it as well. But this statistic is very, very, very negative. You can see it didn't really get far below zero, other than when we had these recessions. Smallest recession in 2001, 2002, and it was pretty negative. Huge recession in 2008, 2009, it was very negative. And now it's almost at the point with the 2001, 2002 recession, but the trajectory is very much down, and it's getting worse. When you put all of these components in together, it's getting worse. And that worries me quite a lot, actually. It's a very strong indicator that the economy doesn't look particularly healthy. This is US housing starts. So I just thought I'd put this in here as well. If I'd have put the data back to the 25-year time frame on trading economics, you could see, in fact, Google it if you're interested. Just have a look at how the US housing starts collapsed in 2007, 2008. I didn't want to compare that because it's not like for like, because obviously 2007, 2008 was a huge housing crisis as well. But obviously when the economy is weak, less houses are being built, less houses are being sold. And we can see that there's been quite a deterioration in the housing starts. And right now we're back down to like 2018 levels, which is not particularly high. So that's basically another bearish indicator. We've also got manufacturing PMI, and United States Purchasing Managers Index. I do apologize here for the very, very small axes. Basically, the red bar is 50, so below 50, manufacturing is contracting, above it's expanding. And this is again on a 10-year time frame. So you can see that the only time, particularly for the manufacturing index, that it dropped below 50 was in that COVID period. When you're getting down to levels like 46, 47, it's not a bullish sign for the economy at all. Purchasing Managers Index, a tiny bit more positive. It had some dips. Excuse me. This on the right is over a 25-year time frame, I've just noticed. So where my mouse is now, that is 2000. That's the year 2000. So you can see dips a bit in a mild recession, 2001, 2002. Dips a lot in the GFC, 2008, 2009. Barely dipped at all. These were sort of like slightly weaker periods in the economy, but they weren't anything dire or to remember. Dipped a lot in COVID, and now it's dipping again. So from a manufacturing standpoint, which again is very much a leading indicator, it does not look good. Company earnings. So this is something that's very interesting to see. This is all from FactSet. Thank you, FactSet, for this data. Overall, 94% of the companies in the S&P 500 have reported actual results for Q4 2022 to date. Of these companies, 68% have reported actual EPS above estimates. That equals below the average of 77 for 5 years and below the 10-year average of 73. So less companies are beating earnings, which is obviously not a good sign. In aggregate, companies are reporting earnings that are 1.2% above estimates, which is below the percentage of 1.3 from last week. However, 5-year average beating estimates is 8.6 for earnings, and 10-year average is 6.4. If 1.2% is the actual surprise percentage for the quarter, which it probably would be because you've got 94% of 1.2, it would be the second lowest surprise percentage reported by the index since 2008. That is very, very, very bearish. You've got companies like Walmart and Home Depot saying, we're expecting the consumer to be weak. These two companies, they have huge market caps, both over 250 billion, I think. It's where, Americans shop the most, both for home improvement and food and everything that Walmart sells. So they're a very good barometer. And if Walmart and Home Depot are seeing it in their figures, that is not a good sign. You can also see, CNBC released this article where they went through the Q1 earnings, and even for some pretty staple businesses, the volumes were down. The volumes were down year on year by quite a lot. Clorox, okay, maybe less people are just being like less hypochondriac because COVID's over, but everything else, things like Procter and Gamble down 6%, and Kraft Heinz down 5%. Not only that, marking that it's recessionary, but you can see how inflationary it is. Like, look at these numbers, up year on year. They're raising their prices hugely year on year. Does this look like the 6% year on year inflation figure we're seeing? It doesn't, does it? It looks more like what many economists would call the official CPI, which actually takes into account housing costs rather than owner's equivalent as rent. There's double-digit price increases. So for me, yes, this is some data that recession is coming, but it's more data that inflation is still out of control. It's stronger on that part for me. Now let's look at valuation, because you always have to compare the current situation to how the market looks. If the current situation is bad, but the market is extremely cheap, there still might be investment opportunities. If the market is slightly expensive, if conditions are if conditions are very, very, very good, but the market is slightly expensive, then there's still an argument to be made for investing in the stock market. There is. So here we have, again, this is from the same article from FactSet, so thank you. The 12-month forward PE is 17.7. That is slightly above the 10-year average. So if you're just looking at the forward PE over the last 10 years, it's about on average. You would say the market is about fairly priced. My only reservation with this is you've got to remember that these last 10 years, they were a time of virtually no interest rates and virtually no inflation. They were golden years. They really were. Well, this is going from 2013. It was really a golden decade for the stock market. It was. There's no other way to put that. And for the conditions that we've just seen, for this market to be fairly valued on a forward PE basis, I don't think that represents an attractive risk-reward opportunity to invest right now. I really don't. That's the way I see it. We can look at some other metrics. If you go back before zero rates, and you look at the S&P 500 since then, we're still about one standard deviation above the mean. People usually say 2 standard deviations, which is the red line, is bubble territory, which is obviously what we were in 2000 and what we were in late 21, early 22. But now we're still one standard deviation above the mean for PE when you compare that back to 1950. We had some very cheap decades for the stock market in the 1980s, which means that that's bringing the standard deviation value up for us now. But the market still does not look cheap. And it's the same with the Buffett indicator. So you're looking at stock market capitalization to GDP. We're about one standard deviation above the mean, which to me, the market still looks like it's moderately expensive. Not in a bubble, but still moderately, maybe slightly overpriced. And for the economic conditions that I think we're facing, that the data is suggesting, I don't think that the stock market represents an attractive risk-reward opportunity right now. In general, I'm talking about systemically, the market as a whole. And then this is just another diagram to show you, sure, if you measure from 2013 to now, the S&P PE ratio is average, but the rates aren't average, and these are only going up. People don't realize how low these rates really were. There was this little increase in about face in 2018, but we're just not used to, the stock market. If we get back up towards the 5% level, then we have to be. We're going to get back up towards the 5% level. We have to be aware of that. We're not at zero rates anymore. If inflation continues to stay elevated, bonds will look terrible. But if the Fed gets really, really aggressive, keeps going, and they do a Paul Volcker late 1970s, all of a sudden those bonds are going to have hugely positive real rates. That brings a very attractive opportunity into bonds. And all of a sudden the market's saying, no, bonds are good, stocks aren't good. However, the market is also saying that at the moment because they're still buying up US Treasuries like nobody's business because they think that the inflation rate is just going to go down to 2-3% overnight. Again, which it could do. I just think that a lot of the data points in the opposite direction. So people might also ask, what do you do for other asset classes? I've touched on bonds. I wouldn't go running into bonds right now because, I want to see more data and proof that the inflation rate is coming down. If we get to a point where inflation goes down to 5% and bonds are yielding 6%, and inflation is continuously going down and there might be a recession, that's a point where bonds look attractive because number one, you've got a positive real rate. And number two, if inflation is going down, you don't have to worry about that inflation risk as much. And number three, if there is a recession, then the Fed will do the about face, cut the rates, and then the price of the bonds will skyrocket back up to represent those new rate cuts. So that's when I would be investing in bonds. Gold is an interesting one. Long term, I'm a pretty big gold bull. I think it's the whole monetary system, just living off printed money is a little bit crazy and it will bite us back in the bum, particularly going from 4 trillion to 8 trillion in Fed balance sheet, literally over the course of a couple of years. However, so let's put it this way. It's bearish for gold when we have positive real rates and the economy is okay. That's the time when it's not good for gold. One of two things could happen, the two extremes. The one extreme is that the Fed can't control inflation and inflation just runs away. We get a 1970s period, the Fed has to keep chasing up inflation. Bonds don't yield positive real rates in the long run. That scenario is very, very good for gold. If the Fed do manage to control inflation and we don't get weakening economic data, that's when gold is not going to do so well. However, if the Fed keeps going with these rate hikes, manages to get inflation under control, but the absence of cheap money, which I think is going to be a big factor and already is a big factor to contributing to a recession, the absence of cheap money is going to cause this huge recession and huge uncertainty. Are we going to be able to live with these rates? Is the economy going to survive? That's the kind of environment where gold will do really well. So I think in the short term, when the market keeps seeing the Fed hiking rates, remember when we saw a shift in the perception of the base rate, but from the Fed funds futures pricing, that kind of environment is not good for gold at all. But any of the two extremes, the Fed is trying to stay in this very, very narrow path, doing the job of getting to positive real rates and not crashing the economy, right? Too far one way and the Fed has messed it up and that's good for gold. Too far the other way and the Fed has messed it up and it's not good for gold. So what I'd say for gold, if you're buying gold companies, a lot of them have high volatility. It's very much a long-term investment and I think the risk reward for gold does look favorable, but in the long term, if the market perceives that the Fed can do it in the short term, as they have been doing for the past month or two, it's not a particularly good environment for gold. All of that is not financial advice. But yeah, in conclusion, those are my current thoughts on the market. I think it'd be a really interesting time. Just another point with regards to stocks. I'm not just sitting there with a bit of cash and a bit of gold. One, because the market is not in bubble territory. As I said, maybe you put the health of the economy, my opinion again, at a 3.5. You put the valuation of the stock market at a 6 and a 6 or maybe a 7. Whilst I'm saying the stock market looks pricey compared to the conditions, I'm not saying it's Armageddon and the stock market's in a bubble. That's the point when you're 80-90% not in the stock market. But what you've got to do is you've got to, always find those investments with good risk reward profile, solid companies with pricing power, companies that are cheap and undervalued that will outperform. I've got companies that are undervalued in my portfolio from Twilio, which is a very cheap young tech company, again in my opinion, all the way to British American Tobacco, which is a very, very mature, high dividend paying company. So you've got the full spectrum. And then the other thing is, if you do agree with my opinions, then you want to remove yourself from companies that are very highly correlated to the index and also have high betas. So high beta, yes, it is something like Twilio. So I've reduced my exposure to that a little bit, even though I think it's undervalued. The stock does move a lot on news as well compared to the actual market. Stocks that are highly correlated are obviously things like Microsoft and Meta. Microsoft is the kind of company that I think will get pulled down with this market, and then it looks very cheap. I think Microsoft is about fairly valued at the moment. Those are the stocks, I'm not going bounding into things like Microsoft, because I think that when the market catches up to the fact that, the economy is not actually that strong and the Fed has a tough job on its hands, these are the kind of stocks that become much cheaper. And if you have high degrees of cash, and if you're holding high degrees of companies that are less volatile and won't get pulled down as much with the market and that pay good dividends, then you're going to have the liquidity. Then you're going to have the liquidity to buy these companies at these cheap prices. Okay, that was everything. Thanks very much for watching the video. Let me know any questions in the comments and enjoy the rest of your day. Goodbye.